You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
Welcome. You are listening to watching the Financial Survival Network. I'm your host, Kerry Lutz. Well, passive investing. You got a number of opportunities, a number of areas where you can do it. But the question is, which one is most advantageous, least risk? Because if you're like me, you don't want to lose money at this point in your life. And you're probably looking for a good return, better than what T-bills and CDs are paying at the present time, even though they have the returns have increased substantially. Well, you're going to hear from Whitney Elkins-Hutten. You are Director of Investor Education at passiveinvesting.com. And first, Whitney, we should just address here passive investing. How do you define it?
Well, so how we define it is, investing in assets that produce a stabilized monthly cash flow, quarterly cash flow, as well as equity build, tax benefits, and provide diversification to the portfolio. We like assets that are backed by hard assets like real estate. Now, you can get passive income from a variety of assets, not all of which are backed by hard assets. But really, the distilled down definition is where you're not trading time for cash flow, time for money. So essentially, you make the investment once, and you're just essentially monitoring and watching the investment, and it's mailbox money. That's passive income.
Right. Like Ben Franklin once said, money makes money, and the money makes more money. So basically, you're describing real estate. What type of real estate are you investing in? What are the risks involved? And how have you been doing it?
Yeah. So, as a firm, we have 1.3 billion assets under management. We invest in multifamily self-storage, car washes, hotels, and first position lien real estate debt, performing debt, by the way. As far as, we have over 3,300 multifamily units, 6,600 multifamily units under management, 3,300 self-storage units, millions of dollars in real estate debt under our belt. We're growing a car wash portfolio of 250 to 300 locations in order to IPO that. And we're bringing our investors along for the ride with us to invest alongside us. Now, obviously, like when you invest in any sort of private equity, it comes with risk. You have the risk that the Securities and Exchange Commission mandates that we tell people, but you have other risks on top of that. So what are the main risks? Well, technically you could lose all your capital. Much like, investing in any asset, there is that potential to lose capital. Now we mitigate that risk, let's say on a multifamily building by raising large reserves, CapEx reserves. Also just, with our underwriting metrics for that multifamily building, we like investing in major metropolitan service areas where populations are growing, jobs are growing, incomes are growing, jobs are diversified. And we not just look at the metropolitan service area level, but also down at the submarket level. And in the case of our self-storage and car wash assets, what street corner are they on and how much traffic is going past them to sustain that business? Another risk in private equity is, the suspension of cash flow. And if anybody here, say, owns a rental, that's just where the tenant, you either have a vacancy, the tenant leaves, or, for whatever the reason, the tenant is unable to pay rent that month. That could suspend your cash flow. Again, the same things, mitigation, tools that we use to preserve capital, we're also using that to preserve the cash flow. You run the risk that the property doesn't appreciate as it would, and that might be as a result of not being able to execute the business plan or outside market risk. Again, that all, you probably have heard the adage, you make money on the buy. That all comes into our underwriting and our conservative due diligence, conservative underwriting upfront to be able to buy high quality assets in performing markets and really stress test the performance of those assets before we actually invest in them. And that's just a few of them. I mean, I'm kind of a real estate geek. We can go down any one of those rabbit holes really deeply. And I would love to help your listeners here really understand how to invest in private equity real estate, especially during this time, this choppy water time. Are we in a recession? Are we not? How can they safeguard their capital, but also create that cash flow now for themselves and allow it to grow before they retire? How do they invest their nest egg safely so it can continue to amplify and build their net worth? And how can they take advantage of those tax benefits, especially bonus depreciation, before it completely ticks away here in 2026?
All right. So looking at it here, I guess you're describing mostly places in the South and the Southwest. Are you buying places in the Northeast and in the Midwest?
We love the Carolinas, the Southeast area, Carolinas, Florida, Georgia, Tennessee, Texas, with self-storage. We also love Colorado and Idaho. We do look at other markets, but the markets have to be, where populations are growing, jobs are diversified, incomes are growing, the average household is increasing, the price of the average household is increasing. But also, especially if we're talking about residential real estate, it has to be landlord favorable, meaning that the laws, actually kind of tilt towards the landlord a little bit, so we can actually work with our tenants on a one-on-one basis as opposed to a one-size-fits-all basis. And also, it has to be tax favorable. So, taxes, especially in real estate, a lot of people, I think, invest in real estate to eliminate their own personal taxes, right? Or significantly reduce them, which is fantastic, but you're still paying tax. But now you're paying it in the form of property tax. How can we make that line item as small as possible? So we look for those areas where tax laws are very favorable to corporate businesses.
Okay. So as far as how one invests in your entity, do you have funds, multiple funds, project by project, single purpose vehicle, financing? How's it work?
Yeah, well, a flavor of all of that. So for our multifamily properties, we do single asset entities, meaning the investor, would see the multifamily building upfront that we have under contract to purchase, and they would get to clearly decide, do I want to be in this market area? Do I want to be in this specific deal? Because as a limited partner investor, you get to control three things: who you invest with, where you invest, the market you're in, and which deal you go into. So especially in this environment, I really love that, because you get to see not only, who you're investing with, where you're investing, the deal, you get to see the lending terms on the deal as well. So those are, you're already eliminating a lot of your risk upfront by knowing those things. Now, on our self-storage and our car washes, we love packaging them in small portfolios. So 3, 5, 7, maybe 9 locations, and then showing those largely to our investors. So you might see 4 out of 5 self-storage or 6 out of 7 car washes. And the only reason why you may or may not see those last 2 is because we have them under contract and we're trying to figure out which ones we're going to put in this fund as opposed to the next fund. And so, but those are different than a fund. They're not blind. You get the same advantage by understanding, who you're investing with, where you're investing, what is the asset, what is the terms on the debt, what does the actual underwriting look like, as opposed to operating off theoretical hypothesis. Mm-hmm. And then on our real estate debt, we invest in first position liens. And, these are with fix and flippers, burr investors, people that are actually holding the property for themselves. And, but these are people that we've worked very long, have a long-standing relationship with. And we're holding that first position lien note. It's typically about 13 months until they go and put permanent debt on it.
All right. And is there a minimum investment here? I assume it's accredited investors only, right?
We work with accredited investors at this point in time, but here in about 6 months, we are looking, we are in the process right now, redlining with the Securities and Exchange Commission, a Reg A fund. And that will actually allow sophisticated investors to invest alongside of our accredited investors in our deals. And so, we'll be able to have something to offer for everybody. Minimum investment, it depends deal to deal. Generally in our single asset entities, about 75K, in our portfolios of 100K or above. And really on those portfolios is because you're getting instant diversification across multiple deals. And so really it lends itself very nicely to investing a larger check. Here's the thing. I encourage anybody, if you're interested in any one of our deals, don't get scared off by the number, especially if you love us and you love the deal. Reach out to me directly and let's have a conversation.
All right, that's reasonable. So the car wash deals, I find it intriguing because those are businesses, real estate-based businesses. If they don't dry your car well or get all the gook off, you're going to leave them basically. How do you scale up managing multiple car washes in multiple locations?
Don't just survive, thrive. The Financial Survival Network.
Torque Resources is an exploration company establishing a portfolio of premier copper gold early stage projects in Chile. Torque's management and technical teams have a strong track record of raising capital, discovery, and monetization of exploration successes. The company's Margarita Copper Gold project is located within the prolific coastal Cordillera Belt in Chile, which hosts some of the world's largest and most profitable copper mines. The Margarita project possesses excellent discovery potential for a major copper discovery due to the strength of the alteration system, large-scale magnetic targets, and the presence of copper oxide mineralization. Drilling is anticipated to begin in Q3 of this year. Torque trades in Canada under TORQ and on the OTC under TRBMF. To learn more, go to torqueresources.com. That's torqueresources.com.
This is the Financial Survival Network, the information you need to thrive now more than ever.
Oh, well, you hit the nail right on the head with the first fact is that it's not commercial real estate. It is a business that owns real estate. So that, we the way we purchase, we actually buy the land, and I actually term it, we own the land and own the brand. So we're not operating a franchise model. We actually we have built our own ground up third-party management company with over 130 employees to be able to take on all these acquisitions, as well as develop, ground up development on other car washes. So that's the bare bones on how we're able to do that. Now, let's talk about car washes for a second. It's a $33 billion and growing industry. It grows at about 4% annually, with the express car wash space growing about double that clip. Now, the express car wash space is a really nice blend of the DIY DIY automatic space and the full service car wash. So really we're, well positioned to, scale it very efficiently because we don't have the large overhead of staff, but we're able to take advantage of all the technology that goes into those type of express tunnel car washes. So you think of this, it's like, if an investor is still very unclear of what I'm talking about, you've probably seen them. You drive into a location, there's a bank of vacuums. You can either vacuum your own car, or you can pay somebody to do it for you. You go through a 60 to 100 foot long tunnel, and that tunnel essentially is taking care of every single part of that wash, pre-wash, wash, wax, even down to the tire shine and drying your car, washing the undercarriage, everything like that. And it's all based on your subscription barcode that you have purchased. And so, this is a very nice income model to invest in because we're not doing single pay car washes. We're moving the client from single pay to a monthly subscription model. So it's monthly recurring revenue. So think of it kind of like on par with self-storage. Yeah. Now, we're picking up these locations from mom and pop owners that couldn't do what you just said. They couldn't scale because there's no third-party management, and they really had to get to about 10 locations before they can hire a regional manager. We're able to come into the space right now before big money gets into it and start consolidating these locations under our property management company.
Okay. Yeah. I happen to belong to one of those clubs, and I'm always wondering if I'm getting screwed or I should just pay by the wash.
Well, you probably won't like what I have to say about the margins on the asset, but it is a very high margin, investment, produces about 40 to 60% margin, on the business. So
Interesting. So,
But the alternative, are you going to wash your car in your driveway?
yeah, there was a time, but I don't really feel like doing it. Although with the amount of time I waste waiting around for them to do their thing on the car, and they're a good one. It's combination. It's mostly hand wash, uh, but yeah. So all your deals, obviously, you're not in this for charity's sake. What do you take off the top on each deal?
Well, I'll get everybody, here listening, our overall structure. So, and maybe just kind of go through the different fees that are in the deal. And so everything that I'm going to say here is net to the investor. So on our car wash deals, we do a 10% preferred return, 60-40 split to 20% IRR, 40-60 to 30% IRR, and 10-90 after that. On our multifamily and self-storage, it looks a little different. We're doing a 7% preferred return and then a 70-30 split to 13% IRR and then 50-50 after that. Now, and we don't do a GP catch-up. So this is really, we really try to align very well with the limited partner investor and put them priority and first in our investments. Now, as far as we do take fees, we take, an acquisition fee, an asset management fee, and depending on the particular business plan of the asset, it might have a capital disposition fee or a refinance fee in there. It might have a construction fee. It just really depends on what's there. But our fees are very low and reasonable, on the lower side of what the industry charges.
Okay. So what have investors, what types of returns have they realized on your deals?
Yeah, we've exited 8 multifamilies to date. And on those 8 deals, we've achieved a 1 point, and this is in 27 months, right? So a very short timeline. So in that 27 months, a 1.6x equity multiple, over a 29% ARR, and a 26.1% IRR to the limited partner investor.
Pretty good. How long you guys been around?
Well, so as a company, the company was formed in 2018, but we've been collectively investing in multifamily much longer than that.
Okay. All right. Well, sounds like an interesting potential. And your distributions get paid out monthly. Is that how that works?
It depends on the asset, monthly or potentially quarterly. It just depends on the asset. But we aim as much as possible to underwrite our deals to do monthly distribution.
So in a car wash deal, you're going to have less tax advantages than on multifamily, correct?
Actually, no. The first year tax loss, we're projecting 70 to 90% year one loss on that investment, as opposed to our Class A multifamily deals, which is about 50 to 60% year one loss. And why is that? It's because when we're buying the location, we actually there's a lot of equipment to depreciate, and we can perform cost segregation analysis, much like you do in multifamily, on that equipment and accelerate those losses forward.
Okay. And that's the same with storage, right? You do the same thing and you have a higher percentage write-off cost recovery your first year.
About 30 to 50% on our storage. And why is that? The reason why it's a little bit lower, because in storage, you're buying, 4 metal walls and a concrete floor. You're investing in garages, and they're upscale garages, right? But there's not a whole lot to depreciate in there as far as like mechanical equipment or fixtures and stuff like that. And your depreciation schedule that you're accelerating against is 39 years as opposed to, say, like with multifamily, 27 and a half. But you can still, with storage, we like deals that have some sort of expansion component to it to, really nudge that, that depreciative loss up closer, to 50%. As well as capture that additional income in order to add to the bottom line and, of course, increase the valuation of the asset.
All right. So going back to the car wash, 70 to 90% tax loss first year. And but obviously that's only can only be offset against passive income because you're passive. But you're actually getting a distribution at the same time as you're incurring the tax loss. Got it.
Exactly. Yeah. So, as we stabilize the asset, year one distribution, it depends on the portfolio, might be, 7% year one, but we quickly are scaling up to 12 to 15% cash on cash by year 3, 4, and 5. So it's a very cash intensive asset. And so, yeah, an investor would love to have those losses to offset that income coming in.
Sure. So car washes, same geographic areas as your other properties, right?
Yeah. So we are focused on the Southeast as we build out, scale our property management company. Right now, this year, we're looking to add another 100. We have 20 locations closed to date. We're looking to add about another 100 to our portfolio this year. We're on track for that. And, we will start expanding out of the Southeast area here, probably like towards the end, middle to end of this year.
All right. I like it. Sounds interesting. So people want to know more about you, want to connect with you on the web. Whitney, how do you do that?
Yeah, they can reach out to me at passiveinvestingwithwhitney.com. That's a subpage on the passiveinvesting.com website. But that's the only place you can get some free goodies and get access to my calendar. And we can talk all things real estate. And the car washes are really nice because it gives investors a great opportunity to still seek yield, but in a very conservative way moving forward. That's just, I see investors chasing yield all the time right now, and it makes me really nervous. Some of the ways that people are doing that.
It's funny. Well, it was always my fantasy in life to retire and own a couple of car washes. Maybe this is getting the benefit of that without having to actually get your hands dirty. Hey, if you got a question for Whitney or myself, shoot us an email, kl@kerrylutz.com. You'll find a link to Whitney's site on our site, financialsurvivalnetwork.com. While you're there, sign up for your free newsletter. Whitney, very intriguing offer there. Thanks so much for coming by.
Thank you for having me.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.